All right. Let's go ahead and open the file. We have a stack of documents on the desk for today's deep dive that, frankly, it scares me a little bit to look at.
Yeah, I mean, it is definitely not your standard Friday morning investment advice, that's for sure.
No,
No.
not at all. It's this wild mix of heavy forensic accounting, some really dense computer code, and what honestly reads like a manifesto for economic warfare.
Looking at the source material we pulled for this intelligence briefing, it really feels less like a financial strategy and more like, I don't know, a survival guide for a collapsing empire.
Right. That is exactly the vibe.
Yeah.
So the mission for this deep dive is to see if we can actually bridge two worlds that historically usually want to kill each other.
Or at least aggressively argue with each other on the internet.
Exactly. In one corner, we have the gold bugs, the people who trust absolutely nothing but physics, atoms, heavy metal.
My people, the
Yeah.
physical purists, we fundamentally believe that if you can't drop it on your foot, it isn't real. If it relies on an internet connection or electricity to exist, it is just a temporary illusion.
And in the other corner, we have the DeFi architects, the coders, the people who think gold is just a heavy rock that's incredibly annoying to transport and that the future of wealth is entirely mathematical.
Usually those two groups are just shouting entirely past each other.
They are. But the dossier we're analyzing today actually proposes a fusion of the two.
Yeah.
A way to take the safety of the rock and sort of inject it with the velocity of the code.
Which, sounds great on a marketing brochure. But as the skeptic in the room, I have to flag the immediate risks here. You are talking about taking the safest asset in human history, gold, and introducing it to the riskiest, most chaotic ecosystem in history.
Crypto.
Crypto. That is a massive, massive friction point.
It is. And that's why we really need to role play this out for the listener. I'm going to take the side of the architect today.
Yeah.
I'm going to argue from the sources that the old banking rails are rusting out, and we actually need this code to survive. I represent the smart money that is just completely tired of asking a banker for permission to move their own value.
Fair enough, and I will stay right here in the bunker. I'm looking at this whole thing through the lens of risk, security, and the very real possibility that your magic internet money just disappears in a puff of smoke.
I expected nothing less.
My role is purely forensic. I want to see exactly where the bodies are buried in this smart contract stuff.
Deal. So let's start with the scenario outlined in the briefing. This is what the sources call the desire loop. Picture this. You, the listener, have been smart. You saw the warning signs. You didn't trust the dollar.
Very prudent.
Right. Over the last decade, you've scraped together $100,000. You bought gold eagles, maybe some silver bars. You've stacked it up. You are effectively your own central bank.
Which is the ultimate goal, right? You have privacy, you have physical insurance against inflation. You are sitting pretty because you have completely removed your wealth from the casino.
Right up until Tuesday morning.
Yeah. Life happens.
Life happens. Maybe the roof on your house collapses, or you have a massive unexpected medical deductible, or a tax lien hits out of nowhere. You need $20,000 in cash.
Liquidity.
Right now. Today.
And this right here is where the trap snacks shut on the gold bug. Because gold is absolutely amazing at preserving wealth, but it is, frankly, terrible at spending.
Yeah, you can't exactly shave off a corner of a gold bar to pay for an emergency knee surgery.
Exactly. You have two options in the traditional fiat world, and honestly, they both stink. Option A is you sell the gold.
Which the purist hates.
Yeah.
Why are you so against selling? You have the asset, you need the money, just liquidate it.
Two reasons. One, you lose the position. You worked incredibly hard to stack that 50 ounces of gold. Once you sell it, it's gone. You are now holding fiat currency again, which is currently melting like an ice cube in the sun due to inflation.
Sure.
But two, and this is the absolute killer that nobody talks about, the taxes. People always forget that in the U.S. and a lot of other jurisdictions, gold isn't taxed like a regular stock.
It's treated as a collectible, right?
Yes. Meaning you aren't paying the standard 15 or 20% long-term capital gains rate you might pay if you sold Apple stock. You're getting hit with a 28% tax hammer.
Wow, 28%.
Plus state taxes, depending on where you live. So to get your $20,000 in clear, spendable cash, you might have to liquidate $28,000 or $30,000 worth of your metal just to cover the tax bill.
That is brutal.
You are literally lighting your own wealth on fire just to access liquidity. It's essentially a penalty for being financially prudent.
Yeah, okay, so selling's out. It's too expensive. That leaves option B, which is the traditional bank loan. You walk into your local Wells Fargo or Chase branch, you put your heavy bag of gold on the teller counter, and you ask for a collateralized loan against it.
Have you ever actually tried to do that in real life?
I haven't, no, but I assume they have a vault.
It is a complete nightmare.
So,
Most local bank branches will look at you like you've got three heads. They don't have a vault for physical precious metals, at least not one they actively manage for retail collateral.
Yeah.
They don't have anyone on staff who knows how to properly appraise an eagle versus a Krugerrand.
and even if you do find one,
If you do manage to find a specialist lender or a pawnbroker, the paperwork is inches thick. They run your credit, which dings your credit score. They demand to know exactly what the money is for. And then the absolute worst part, you have to hand your physical gold over to their custody.
and that breaks the absolute first rule of the physical purist, doesn't it? Possession is 9/10 of the law.
Correct. The second you slide that gold across the counter and it goes into their vault, it is officially their gold. They owe you the value, sure, but if that bank fails or goes into receivership, you are just an unsecured creditor standing in a very long line hoping to get pennies on the dollar.
You're trusting a counterparty.
Exactly.
So this brings us to the third option, the architect's solution from our dossier. What if I told you that you could get that $20,000 in exactly 12 seconds?
I'm listening.
No credit check.
Yeah.
No human banker giving you permission. No taxable event whatsoever. And you never actually sell the gold.
I'd say it sounds like a Ponzi scheme or a highly sophisticated trap.
It really does, doesn't it? But according to the sources, it's actually just forensic finance applied to the blockchain.
Okay.
We are going to open the file on self-custodied, tokenized metals, and decentralized finance, DeFi. We are going to see if it is actually possible to execute the billionaire strategy, what they call buy, borrow, die, without ever stepping foot inside a traditional bank.
Okay, let's unpack this completely. But before we get to the actual mechanics of how this so-called robot loan works, we really need to understand the broader context.
Oh, why?
Right. Why would anyone take the inherent risk of moving their physical, safe wealth into the digital realm? Why are people trying to leave the traditional banking system at all?
Because of the digital squeeze.
Yeah.
This is section 1 of our briefing, and we really have to look at the harsh reality of the modern banking system. The sources we're looking at here are pretty dark on this topic.
They spend a lot of time on the concept of debanking. And this is a term that's moving very quickly from the fringe internet blogs right to the front pages of major newspapers.
It used to be that if you had money, the bank wanted your business. End of story.
Exactly. That is no longer true at all. Debanking is the documented practice where financial institutions just suddenly close the accounts of individuals or entire businesses, and not because they committed financial crimes, but because they represent a quote-unquote reputational risk.
Reputational risk, that is such a massive catch-all phrase.
It covers almost anything.
And look at what the sources say we've seen in just the last few years. They talk about Operation Choke Point 2.0. This is where regulators quietly pressure the big banks to just completely cut off service to entire legal industries.
Crypto companies, firearms dealers, adult entertainment.
But the sources point out it's getting much more granular than just businesses. They highlight what happened in Canada during the trucker protests.
Right. The sources identify that as a major watershed moment for the smart money. The Emergencies Act was invoked by the government.
And what happened?
Bank accounts of everyday people who simply donated $50 to a protest were entirely frozen.
Wow.
There was no trial, there was no judge issuing a warrant. It was just a digital freeze order sent directly to the bank database, and suddenly you couldn't buy groceries.
And that right there is the terrifying realization for the people reading this dossier. Your bank account is not actually a vault, it is just a permission slip.
A permission slip that can be revoked.
Exactly. You are allowed to access your money only as long as you remain in good standing with the intermediary holding it. If you fall out of favor politically, socially, or commercially, your liquidity just vanishes overnight.
And the purist in me has to note that this is exactly why we hold physical gold in the first place. You cannot send a digital freeze order to a gold coin buried in my backyard.
That is entirely true.
Look.
But you also can't send that gold coin to pay a supplier in Tokyo in 10 minutes. And the digital squeeze is getting tighter. The sources heavily highlight the looming rollout of CBDCs, Central Bank Digital Currencies.
Explain what that means for the listener who might not be deep into Forex. This is the government issuing its own digital version of the dollar or the euro, right?
Right. It's not crypto like Bitcoin. It's a digital dollar controlled directly by the Federal Reserve or the ECB. And the key feature of a CBDC, according to the sources, is programmability.
Programmability.
Yeah. Now, the architect in me looks at that tech and sees incredible efficiency. Instant settlement, no wire fees, perfect tracking.
But the skeptics see something else.
The libertarian sees a massive trap. If the money is programmable, the issuer or the government can dictate the exact terms of its use.
Give the listener a concrete example of how programmable money could actually work against them.
Okay, imagine you go to the government bank and you ask for a loan. They say, sure, here's $20,000. But the code physically attached to these digital dollars says you can only spend it on government-approved vendors within a 10-mile radius of your home.
To stimulate the local economy, they'll say.
Exactly. And to make it worse, it has a programmed negative interest rate, meaning if you don't spend this entire $20,000 within 30 days, it automatically deletes itself from your wallet.
It essentially creates an expiration date on your own economic freedom. It turns money into a highly controlled voucher system.
It's the old coal mining company store, but on a massive national scale.
Exactly. And the smart money, the people who really understand how this financial plumbing works at the deepest levels, they flat out refuse to beg for programmable debt.
They want liquidity, but they demand it on their own terms. And this brings us right to the billionaire strategy mentioned in the dossier.
Buy, borrow, die. It's a classic, very high-end wealth management technique.
It is. And honestly, it's surprisingly simple once you see the mechanics. Let's look at someone like Elon Musk or Jeff Bezos, right? When they want to buy a massive new super yacht or a $50 million mansion, do they log into E-Trade and sell a bunch of their Tesla or Amazon stock?
Absolutely not, because selling triggers a massive capital gains tax event. If you sell $1 billion of stock, you might owe $300 or $400 million straight to the IRS.
Correct. So instead of selling, they go to a massive prime broker, a JP Morgan or a Goldman Sachs. They pledge their billions in stock as collateral.
Right.
The bank gives them a massive cash loan at an incredibly low interest rate. They take that cash, they buy the yacht.
Because a loan is not income.
Precisely. The loan is debt, not income, so it is completely tax-free. They live off the loan money. Then eventually, when they pass away, the estate settles the debt, often utilizing a stepped-up cost basis on the assets, meaning the taxes are either severely minimized or eliminated entirely.
It's a brilliant strategy, it really is. But there's a massive catch for the listener here. You generally need to have $100 million to even get that meeting at Goldman Sachs.
Exactly. You need a highly connected private wealth manager. You need institutional access. The average person who has $100,000 in gold eagles cannot just walk into JP Morgan and casually ask for the Bezos special.
They will literally get laughed out of the lobby.
They will. So the core argument of this entire briefing is that technology is fundamentally democratizing this exact strategy.
Okay.
DeFi, decentralized finance, replaces the expensive private wealth manager with open source code. It replaces the VIP handshake with a smart contract. It theoretically allows you to be your own Goldman Sachs.
Okay, but as the physical purist, I really have to stop you right there. You were talking about replacing banks with code, sure, but you were also talking about taking my physical gold, my hard, heavy, reliable offline gold, and turning it into a digital token.
I am.
This brings us perfectly to section 2 of the briefing, the definition. Because to me, reading these sources, this sounds exactly like the tokenization trap.
Tell me more about that specific fear. What exactly do you see when you hear the phrase digital gold?
I see an IOU. I see a fragile spreadsheet entry on a server I don't control. The source material talks heavily about the Wall Street RWA trap.
RWA standing for real-world assets.
Right. The traditional banks are currently desperate to tokenize absolutely everything. They want to put commercial real estate, regular stocks, and hard commodities onto a blockchain.
Which sounds amazing on paper. It makes highly illiquid things instantly liquid.
But here's the catch. If that blockchain is ultimately controlled by the bank, if it's what they call a private or permissioned ledger, then we are right back exactly where we started.
Right.
If the token representing my gold is just sitting on a JP Morgan proprietary ledger, they can freeze it just as easily as they can freeze my standard checking account. If I trade my physical gold bar for a bank-issued gold token, I haven't gained any actual freedom.
No.
I've just changed the formatting of my servitude. It's totally pointless from a sovereignty perspective.
You are 100% correct. And this is probably the most critical distinction we need to make in this entire deep dive.
Make it.
The strategy outlined in the dossier is not talking about bank-issued tokens on private ledgers. It is specifically talking about self-custody tokenized metals.
Okay, explain that difference very clearly. How can I possibly self-custody a purely digital representation of a physical object? It frankly sounds like an oxymoron.
Okay, let's look at the asset itself first. The sources explicitly mention tokens like PADX gold ticker symbol, PAXG, or similar decentralized protocols.
Okay.
These are cryptographic tokens running on a massive public decentralized blockchain, usually Ethereum.
So not a bank server.
No, thousands of independent computers worldwide. Now, each specific token mathematically represents exactly 1 troy ounce of fully allocated physical gold.
And where is this physical gold?
Sitting in a heavily guarded third-party physical vault, like a Brinks vault in London or Switzerland.
Okay, so the actual gold exists. It's in a real vault with real guards. But who legally owns it?
The entity that holds the cryptographic private keys owns it. This is exactly where the hardware wallet comes into play.
The hardware wallet.
Yes. If you buy that token and move it off the centralized exchange and directly onto your own physical ledger or Trezor device, you hold the keys.
Meaning, I am the only person on Earth who can authorize that token to move.
Exactly. Let's look at the visualization the sources provided.
Yeah.
The unfrozen account concept. Imagine a split screen in front of you.
Okay, I'm picturing it.
On the left side of the screen, you have your traditional bank app. The government sends a freeze order, and instantly, a massive red banner appears. Account frozen. Your money is completely trapped.
A nightmare, but a reality.
Right. Now, on the right side of the screen, you have your physical hardware wallet. It holds your tokenized gold. Because that specific token lives on a completely decentralized, permissionless blockchain, BlackRock cannot freeze it.
Right.
The Federal Reserve cannot confiscate it. They literally do not possess the admin key to the Ethereum blockchain.
So technically speaking, it's a digital bearer asset.
Yes,
Yeah.
exactly. Just like the physical silver quarter in your pocket is a bearer asset, meaning whoever physically holds it owns it. The token secured on your hardware wallet is a digital bearer asset.
But the gold is still in a vault run by a company. Yes, but as long as the vaulting company, the actual people physically guarding the gold bars, are regularly audited and structured to be bankruptcy remote, you have successfully bridged the gap.
Bankruptcy remote is a very key phrase there from the forensic side. It means legally, if the company issuing the token completely goes bust and files Chapter 11, their creditors cannot lay claim to the physical gold in the vault.
Exactly.
The gold belongs exclusively to the token holders, not the issuing corporation.
Precisely. It is a very specific legal structure designed entirely to protect the asset. So the purist really has to admit here, if you actually hold your own keys, it is functionally and legally different from a standard bank account.
I will concede that point. If I hold the private keys and the underlying code is truly decentralized, it is significantly harder to seize than a checking account. It is highly censorship resistant.
Right.
But it's still not physically in my hand. However, I do understand the trade-off being proposed here. I am intentionally trading physical, immediate possession for immense digital utility. Right. And that immense utility is exactly what we discuss in Section 3. The mechanism. This is where we fully enter the digital pawn shop.
I actually really like this analogy from the briefing because pawn shops are gritty. They deal in absolute reality. You bring in a Rolex watch, they hand you cash, no credit checks, no background questions.
But this particular pawn shop is very different. It's completely run by a robot, a smart contract, and we really need to be crystal clear with the listener about what that actually means.
It is not artificial intelligence.
No, it's not AI. It's not some friendly chat bot making nuanced, subjective decisions about your characters.
It is pure logic.
It is a vending machine made of digital granite. The rules are permanently carved into the blockchain. If A, then B. It fundamentally does not care who you are.
Right.
It does not care about your FICO credit score, your last name, your race, your gender, or your politics. It solely cares about the math.
So walk us through the actual workflow here. I have my $100,000 of tokenized gold secured on my hardware wallet.
Yep.
I desperately need that $20,000 for my life emergency. What actually happens, step by step?
Okay, step 1. You take your hardware wallet and you connect it to a major DeFi lending protocol. There are several blue chip ones out there. Ivy is the very famous one. But there are others specifically built for real-world assets.
And this is usually done just via a standard web interface.
Yes. You go to their website, you click the button that says Connect Wallet, and you physically approve the connection by pushing a button on your little hardware device.
Let me do a quick security check right here. I am not giving that website my actual private key, right?
Never. Absolutely never. You're merely signing a cryptographic permission slip that basically says, this website can view my public balance and it can request transactions.
But I still have to manually approve every single action.
Yes, exactly.
Oh.
So step 2, you deposit your collateral. You initiate a transaction to send your $100,000 of gold tokens directly into the smart contract. The open source code locks it up. It is now officially held in escrow by the robot.
So it's sitting in the digital vault. The vending machine has officially swallowed my gold.
Correct. Step 3, you borrow. The smart contract instantly sees mathematically that you have $100,000 locked in the vault. It automatically creates a borrowing limit for you based on that collateral.
Okay.
You type in $20,000 and you select the specific currency you want to receive. Usually in this ecosystem, this is a stable coin, like USDC or USDT.
And a stablecoin, just for clarity, is a digital token that is pegged perfectly one-to-one with the US dollar.
Correct. So you are essentially borrowing digital dollars against your digital gold.
Got it.
And step 4, you click borrow. You physically confirm the transaction on your hardware wallet. And this is the absolute kicker that blows people's minds. About 12 seconds later, the $20,000 in stablecoins just appears in your wallet.
12 seconds.
12 seconds. No human being reviewed the file. No loan underwriter stamped it. The code literally just checked the math. Is collateral greater than loan amount? Yes. Execute transfer.
And what about the terms of this loan? What exactly am I paying for this privilege?
That's the beauty of the DeFi system. There are no monthly minimum payments required.
None.
None. In DeFi, you usually just have to keep the overall health of the loan in check. The interest absolutely accrues in the background, but you do not have to mail a check every single month.
And the interest rates?
They are completely determined by the real-time supply and demand in the open market, built into the code. They are very often significantly lower than a standard personal unsecured loan from a retail bank.
But the real massive benefit here, the entire reason we are even discussing this crazy strategy, is the tax angle.
This is crucial. I cannot stress this enough for the listener. When you receive that $20,000 in stablecoins into your wallet, it is legally a loan. It is debt.
And under the tax code, debt is not income.
Exactly. You do not pay income tax on it. You do not pay capital gains tax on it. You have successfully extracted vital liquidity from your gold without triggering that massive 28% collectibles tax event.
And you still own the gold.
Right. You keep the upside potential of the asset. If the price of gold doubles while it's locked in that smart contract, that is entirely your gain, not the robot lender's.
So just to close the loop on the transaction.
When you are finally ready, whether that's 6 months later, 2 years later, whenever you want, you just pay back the $20,000 plus whatever interest accrued. You send the stablecoins back into the smart contract. The robot mathematically sees the debt is perfectly settled, and it instantly, automatically unlocks your gold tokens and sends them right back to your hardware wallet.
It is very elegant. I have to give you that as the architect. It is incredibly clean. It entirely removes the human friction from finance. But
I hear the but coming.
You know it's coming. Because we are now officially entering section 4 of the briefing, the purist's warning.
Let's hear it.
Because honestly, all of this sounds like a perfect techno-utopia. And as a forensic analyst, my entire career has taught me that utopias are usually just incredibly expensive illusions. This is forensic finance. And the risks we are dealing with here are not just your standard, the market goes down a little bit risk. They are completely catastrophic.
Agreed. Let's switch gears completely. We have painted the rosy billionaire lifestyle picture. Now let's heavily examine the dark side. What exactly keeps the physical purist up at night when looking at this dossier?
DeFi is the Wild West. That is the massive headline you need to understand. There is zero FDIC insurance here. There is no friendly 1-800 customer service number to call.
No branch manager to complain to.
Exactly. If you mess this up, you cannot call the manager and ask for a reversal.
So let's break them down. Risk number 1.
Smart contract risk. We are putting all our faith in trusting a robot, right? Well, who actually built that robot? A human being. And humans constantly make mistakes.
Coding errors.
Exactly. If there is a tiny bug in that smart contract code, a misplaced comma, a weird logic loop, a sophisticated hacker will eventually find it and exploit it. They can completely drain the digital vault.
And we should be clear, this is not theoretical. This has happened. We have seen major DeFi protocols drained of millions of dollars in minutes.
Hundreds of millions. Look at the Euler finance hack the sources mention. Look at some of the major cross-chain bridge hacks. If I put my entire life savings of tokenized gold into a smart contract and that specific contract gets hacked, my gold tokens are gone forever.
Even though the physical gold is safe.
Right. The physical gold is still sitting safely in that Brinks vault in London, but the cryptographic token proving that I am the owner is now sitting in a North Korean hacker's wallet.
That is a terrifying reality.
Yeah.
So how exactly does the smart money mitigate this specific risk?
Well, they don't go chasing the shiny new object. They strictly only use what we call battle-tested blue-chip protocols. They look for smart contracts that have billions of dollars in TVL.
TVL being total value locked, meaning if there are $5 billion just sitting in the contract right now, and it hasn't been hacked in 4 straight years of being live on the internet, it's likely pretty secure.
Likely, but importantly, not guaranteed. They also aggressively look for audits. Multiple, highly independent security firms that have rigorously reviewed the open source code line by line.
Right.
If a brand new lending protocol launched just last week offering amazing interest rates and it has no external audit, you stay far, far away. Using that is basically walking into a dark alley at midnight with $100 bills hanging out of your pocket.
Very fair warning.
Yeah.
What is risk number 2?
Liquidation.
Yeah.
We talked earlier about how the robot only cares about the pure math. Well, sometimes the math can turn violently against you. These are fundamentally over-collateralized loans. You put in $100,000 to borrow $20,000.
Which sounds incredibly safe.
It is safe, but human nature kicks in. What if you get greedy? What if you put in $100,000 of gold, but you decide to borrow $80,000 against it?
Okay, yeah, that's getting risky.
Extremely risky, because if the global market price of gold suddenly drops, and it absolutely does drop during liquidity crunches, the overall value of your collateral falls with it. If that value falls below a mathematically coded threshold, the robot does not call your cell phone to politely ask for a top-up. It doesn't send you a warning letter in the mail. It just mercilessly executes a liquidation.
It automatically sells your gold.
Instantly. It sells off enough of your underlying gold tokens on the open market to completely pay back the loan. Plus, it usually slaps you with a hefty penalty fee. You permanently lose your physical asset position.
And we really need to mention the oracle risk here too, right?
Yes, absolutely. The oracle is the specific piece of external code that tells the isolated smart contract what the current real-world price of gold actually is.
It feeds the data in.
Right. If that oracle somehow gets manipulated by a bad actor or hacked, and it falsely tells the robot, hey, gold just crashed and is now worth $1 an ounce, the robot will instantly liquidate everyone in the protocol without a second thought.
So the key strategy here is maintaining a massive margin of safety.
You have to be incredibly conservative. The sources strongly suggest never borrowing more than 20 to 30% of the total collateral value.
The LTV, loan to value.
Right. If you have $100,000 in gold, you only borrow 20 or 30 grand. If you stick to that ratio, the physical price of gold would have to crash by something insane like 60 or 70% overnight before you are even remotely at risk of liquidation.
Which, historically speaking, for a hard asset like gold is highly unlikely. It's not some volatile, crazy meme coin.
Exactly. But it is mathematically possible. So you absolutely cannot just set it and forget it completely. You have to actively monitor the health of your digital loan.
Okay, risk number 3. And I know this is the absolute big one for you, isn't it?
OPSEC. Operational security. This is where 99% of normal retail people fail completely. The famous mantra of crypto is not your keys, not your coins.
Right.
But the very harsh flip side of that is your keys, your absolute responsibility.
We mentioned the hardware wallets earlier.
Yes, but simply buying one off the internet isn't enough. You have to use it perfectly. The absolute biggest mistake people make is buying tokenized gold and then just leaving it sitting on a centralized exchange like Coinbase or Binance.
Why is that such a fatal mistake? To a normal person, it actually feels safer. The exchange has password recovery, they have 2-factor authentication, customer support.
It feels safer precisely because it feels exactly like a traditional bank. But if that specific exchange goes bankrupt, and look at FTX, look at Celsius, it happens, your paper gold is instantly gone.
You don't hold the keys.
Exactly. You are just an unsecured creditor trapped in a decade-long bankruptcy court proceeding. You absolutely must withdraw those tokens to your own offline device.
The actual physical device that looks like a little USB stick.
Yes. But even then, where's your seed phrase?
The backup.
Those 12 or 24 random words that restore your entire wallet if you lose the physical device or drop it in a lake.
Right.
If you type those words into a connected computer or you take a quick photo of them with your phone and save it to your Apple iCloud, you are totally compromised.
Because if a hacker gets into your iCloud account, they just see the photo of your words and they can clone your entire wallet from halfway across the world.
Correct. The seed phrase must absolutely never touch the internet. It must remain strictly analog, pen and paper, hidden away. Or even better, physically stamped into a fireproof steel plate so it survives a house fire.
So the explicit warning here is keep the seed phrase analog, never ever digital.
Never digital. And for the truly paranoid like me or the people securing millions of dollars, you don't even rely on one device. You use a multi-signature setup. Multi-sig.
Explain how that works briefly.
It's exactly like a nuclear submarine launch sequence. You need 2 separate keys turned at the exact same time to fire. A multi-sig digital wallet requires, say, 2 out of 3 separate physical signatures to approve any outbound transaction.
So 3 different devices.
Right. Maybe 1 key is on a ledger kept in your home safe. 1 key is on a Trezor device kept in a bank safety deposit box across town. And the 3rd key is held with a trusted estate lawyer.
So if a hacker somehow gets their hands on one of your keys or your house gets robbed, they can't actually steal the digital gold. They absolutely need the second one to move the funds.
Exactly. It completely removes the single point of failure. Because let's be totally clear here. It is an amazing tool, this digital vault. It really is. But if you lose your private keys, or if you get tricked by a phishing website, or if the smart contract drains, the gold is just gone. There is no government FDIC bailout coming to save you.
That is a very sobering reality check. This strategy is essentially a massive power tool. It can build you a beautiful house, or it can instantly cut your arm off. It depends entirely on the skill and discipline of the operator.
Very well put.
So we've covered the digital squeeze, the definition of self-custody, the mechanism of the loan, and the severe risks. Now, we really need to synthesize all of this source material.
Bring it all together.
All right. We need a definitive verdict for the listener who's currently standing at this financial crossroads. We are looking at what the sources call the 2026 filter, anticipating exactly where the world is headed next.
The modern financial landscape is increasingly hostile to the individual saver. That's just the baseline reality from all the data. Between hidden inflation, aggressive taxation, and digital surveillance, the average person's wealth is actively under attack.
So given all that, do we go full digital? Or do we stay full physical?
I think the source documents are clearly pointing toward a hybrid approach. The world isn't black and white. So as the physical purist, here is my final verdict based on the evidence. Well, physical first.
Do not abandon the real world atoms.
Never. The absolute foundation of your wealth must always be physical atoms you can actually touch in a heavy safe inside your own home. This is your ultimate insurance policy against the power grid going down, against systemic bank collapse, against the internet just breaking. You desperately need that base layer of reality.
But, as we discussed, you cannot easily email a heavy gold bar. You can't spend it efficiently at the grocery store or pay a sudden medical bill without a massive tax hit.
Correct. Which is exactly why the architect's verdict is also highly valid in today's world.
My verdict, representing the smart money from the dossier, is tokenize for pure liquidity.
But not everything.
No. Don't tokenize your entire net worth, but tokenize a strategic portion. Use the decentralized blockchain ledger purely as an engine for fast, tax-free, permissionless loans when emergencies strike.
It's essentially a very specific tool for a very specific job. You don't use a heavy hammer to brush your teeth. You use cryptographic tokenization simply to bypass the private sale tax trap and the intrusive banker.
The ultimate goal here is to completely separate your hard-earned wealth from the banking system's control, but strictly maintain the modern utility and velocity of money. It's essentially the 80-20 rule.
Explain that.
Keep 80% completely in the dark, off the grid, buried in the physical safe. Put 20% on the digital rails for speed and liquidity access.
I agree with that ratio. And the final piece of advice from the briefing that perfectly combines both of our viewpoints. Guard the keys.
Yes, above all else. If you are going to attempt this billionaire strategy, you have to become an absolute professional at personal security. Master your digital OPSEC long before you execute a single smart contract.
Practice.
Exactly. Do not try to learn this complex system on the fly with $100,000 of your life savings on the line. Learn with 50 bucks.
Test the plumbing of the system. Send a tiny amount of collateral, borrow $10, pay it back the next day. Actually see how the interface feels. Understand the friction points and the gas fees. Then, and strictly only then, consider moving a larger stack of wealth.
That is incredibly sage advice. It really all comes down to this core concept. Accessing global liquidity without ever asking a traditional banker for permission is an absolute superpower.
It is.
But like all superpowers, it requires immense discipline to wield without destroying yourself.
And it deeply requires a full acceptance of personal responsibility. When you use DeFi, you are effectively firing your banker. But that strictly means you are now the banker.
You take on all the jobs.
Right. You have to personally do the security audits. You have to meticulously manage the private keys. You have to actively monitor the liquidation risk. There is no safety net.
So as we wrap up this intelligence briefing, I want to leave the listener with a final provocative thought to chew on. We've spent a lot of time talking about the cold mechanics today, but let's talk about the underlying feeling for a second.
And psychology of the whole thing.
Exactly. Ask yourself, does the idea of interacting with a smart contract, a completely faceless, soulless piece of open source code for a major financial loan terrify you? Or does it actually sound like ultimate financial freedom?
It really is a fascinating Rorschach test for the 21st century. Your gut answer to that question essentially tells you exactly which side of financial history you're betting your future on.
And here is a prediction from the fringes of the source material to really ponder. We know from the data that governments inherently crave control over money.
Of course.
The upcoming CBDCs are fundamentally about tracking and surveillance. So will they eventually try to outright ban self-custodied tokenized metals?
Oh, they definitely will.
Will they try to make it legally a crime to hold your own cryptographic keys simply because it allows you to completely escape their closed programmable system?
I think they will absolutely try. They will aggressively try to regulate the on-ramps and the off-ramps, the exchanges where you buy and sell.
But the real question is, can they actually stop the open source code?
That is the big trillion-dollar question. History strongly suggests that mathematics and code are very, very hard to kill. Once a truly decentralized idea is out there functioning on thousands of computers, it's virtually impossible to put the genie back in the bottle.
That is very true. We want you to really think about your own digital vault strategy this week. Are you completely exposed to the whims of the traditional banking system?
Do you have a functional escape hatch built?
Exactly. And remember, gaining knowledge without taking action is just entertaining trivia. If this specific briefing sparks something for you, go verify it.
Read the white papers.
Do your own deep research. Do not blindly trust us. Verify everything yourself.
That is the ultimate motto.
This has been The Deep Dive. Remember, the future belongs to the owners. We'll see you all in the next intelligence briefing.
Stay safe out there.